Good morning, everybody. You're very, very welcome to this morning's webinar. My name is Mark Spence, and I'm Managing Director of CEF. And this morning, I'm delighted to be hosting this webinar with our patrons from ABL Group Insurance, one of Northern Ireland's leading insurance groups. And we're delighted to be associated with ABL, and very excited this morning to have with us Mark McAllister, who's Head of Trade Credit with ABL, and Terry McCauley, who's Senior Risk Officer Trade Credit with Tokyo Marine HCC. And Mark and Terry are going to cover the issue of trade credit insurance, which we all know is a highly relevant topic at the moment. We live in very unusual times, very challenging times for the construction industry. There are many pressures on cash flow at the moment, rising costs and the imbalance of risk in contracts. So many issues concerning main contractors and their supply chains, and trade credit insurance can be part of that complex set of relationships. And we're absolutely delighted this morning that ABL are supporting us and you, our members, with giving an insight and some of their advice. Just in terms of the morning, both Mark and Terry are going to be talking through some of the key points on trading credit insurance, and I think that'll take about 40 minutes. We'll have questions and answers at the end. What I would do, just because there's a large number of people, if you see the Q&A button at the bottom of your Zoom screen, if you click on the Q&A button, if you have a question to raise and type it in there, I will pick up those questions at the end and I'll share those questions on your behalf with Mark and Terry at the end of the session. Just for your information as well, the session is being recorded. That's so that we can add this to our bank of sessions on our CEF YouTube channel, and it allows you to share it with colleagues who couldn't make it today, or refer back to it later on when it's of more interest to you. So with little more ado, I'm going to pass over to Mark and welcome you, Mark, your first CEF webinar with ABL Group. You're very, very welcome this morning, and look forward to hearing what you and Terry have to say.
That's great. Thank you very much, Mark. Thanks very much for the warm welcome. It's great to have this opportunity to be able to present trade credit insurance to your members, to highlight the important role that trade credit insurance will play for all sectors in business going forward, and in particular construction as well. I would like to also extend my thanks to the CEF team for arranging this webinar, getting the presentations and that, making sure they run smoothly, etc. Very much appreciated. It's great to see such a large number of CEF members on the call today. I trust you find this webinar is beneficial and you find it informative as well. As Mark has highlighted, any questions or whatnot, pop them in the Q&A and we'll be happy to answer at the end. I'd like to welcome as well Terry McCauley, Senior Risk Officer from Tokyo Marine HCC. We are a leading trade credit insurer within the trade credit insurance market. It's great to have Terry across. He's come across from England. Great to have him here in person with us here in Northern Ireland. We look forward, Terry, to you speaking as well on the webinar. As Mark has mentioned, I head up the trade credit division within the ABL Group. ABL Group is the largest commercial insurance brokerage and risk management company in Northern Ireland. We have 5 key office locations in Belfast, Armagh, Coleraine, with Digney, Granson, Uri, McGrady Insurance in Downpatrick. We have over 175 employees across those 5 geographical areas. We support insurance solutions in the private sector and the public sector as well across the UK and Ireland market. We're also part of Brown & Brown. They're the 5th largest global insurance brokerage in the world at the moment. They have an excess of $25 billion of premium, which is annually written. So before we move on into the contents of the presentation, I want to just give a wee brief overview on what I plan to share with you today. I want to highlight a bit of a fact-filing mission on trade credit insurance, what it's about, etc., what all it involves. I would like to look then at the credit risk management side in terms of how do you protect your own credit rating. And then finally, there'll be a brief chat on the insolvency sector, construction and the insolvencies happening at the moment. So without further ado, what is trade credit insurance? This is obviously a key question. What exactly is it? What does it do? What does it do? Trade credit insurance protects businesses against the impact of bad debt. This is caused by the failure of the customer to not be able to pay for their goods or services sold on credit. The likes of insolvency is covered, protracted default is covered as well in terms of your business or your customer still trading, but not being able to pay within the allocated terms of the contract. These aspects are all covered within a trade credit insurance policy. Trade credit insurance is worldwide. It covers domestic and export sales, along with political risk. So the majority of the insurers have underwriters all around the world. It's the same process happens in New Zealand, Norway, as it would in Northern Ireland here. The underwriting approach is the same across the board. The most common your whole debtor ledger. It covers the spread of all your customers. This is the most most cost-effective way to pay within the trade credit insurance policy is that it's unique to every individual business. It's tailored to suit that business, and it's applicable to all sectors and all levels of turnover. We sort of dive a bit more deeper then in terms of a construction policy. What exactly does that consist of? What does that entail? What modules and what aspects are within that? Most insurers have their own construction policies in place, have their own wordings in place. You would have the likes of work certified and not paid, work done on site after the last valuation, work done outside the policy period where cover is extended, on fixed materials and goods on site and off site. Retentions or final account balances can be certified in the policy period as well, and they are covered. You also can have sums falling due under an adjudicator's binding decision, which would be covered as well under a trade credit policy under construction. There is additional modules that can be added on within the construction policy. You can have work in progress or pre-credit risk, as some insurers call it. There's bound contract cover. So again, it's back to the scenario that the policy suits your business. The policy can be adapted to suit your business. There's no one policy fits all. We look at then an important question in terms of trade credit insurance. How do we cost it? How is it quantified? As you can imagine, with the many variables within trade credit insurance, there's no one set cost for a policy for a certain industry or a particular company. There's three key areas that really the algorithm works out and turns out a policy rate then and turns out a costing element. The three key areas is the insurable projected turnover. So this is where you would have your insurable projected turnover only. And by that, I mean in terms of any government or public sector work, etc., the likes of VAT and cash sales, this would all be stripped out. This would give you then your insurable projected turnover figure. Spread of debtors, again, as I've mentioned before, the whole turnover aspect is the most cost-effective way to have a trade credit insurance policy in place. The spread of your debtors will affect, obviously, the price element. You can go down a concentrated buyer route. You can also go down then the line of single risk cover, which accordingly becomes more expensive if you look at those options. Thirdly, then, the recent bad debt history. Like any insurance product, the underwriters will want to see a bad debt history, to see if that exists, to understand is there any current overdues that's causing concerns. Whenever these three key elements then are all put into the algorithm, your insurable projected turnover, your spread of debtors, your recent bad debt history, this then turns out a premium rate and a costing aspect. Just to give you a bit of context and sort of to give you a bit of a range as to where we're at the moment on costing, the market is actually very keenly priced. The reason that is at the moment is the past 2 years with COVID, as we're all well aware of. It has affected businesses in many ways. Insolvencies was one aspect that was expected to rise, and claims on the back of that to rise. That hasn't materialised in 2020 and 2021, due to obviously to the likes of government support and different mechanisms put in place to support businesses as they work through this sort of trying period. So therefore, the premium rates are very low in comparison to pre-COVID. If we look at pre-COVID, you're probably looking at a rate of 0.4 starting point from a whole turnover policy. If you look at pre-COVID and the single risk side of things, you're looking at a rate of 3 to 4%. Whereas we can see at the moment we're currently rates are being offered from 0.2 up on the whole turnover and then 2% on the single risk rate. I suppose just a note on the single risk rate, it is based solely on the insurable risk. So if your insurable risk is $500,000 or $1 million, then your insurance cost is based on that, and that's where the 2% element comes in. We just look then at why trade credit insure. Obviously, many businesses will have different views, different opinions, as to what red flags up the likes of trade credit insurance or why review it at this stage. I've simply put together here 7 key factors that I believe is having a big bearing on the economy at the moment. I'm not going to chat through them in detail, as I know Terry is chatting on some of them later in his PowerPoint. If we look at the likes of inflation, we're sitting at 9% inflation now at the minute. It's going to creep into 10%. All as forecast is now in the autumn time. That is going to have an effect then on different aspects, rising material costs, labour shortages, etc. We have the Ukraine crisis ongoing at the minute. Brexit is still floating about as well. We're still coming off the back of COVID. We have the no functioning local government here in Northern Ireland, which doesn't help, and particularly within the construction sector, it's very challenging then for contracts to be won on the public sector side. Projects are being delayed, etc. This is having a domino effect. If you put all these into the mix, which we do have at the moment, it does give a bit of a recipe for disaster, should we say. It does give a bit of cause for concern. The market has changed. The economy has changed a lot in the past 2 years. We have COVID and different things that people didn't foresee before, we couldn't foresee before. It's very challenging for businesses moving forward. And certainly these aspects all lend the route sort of down to looking at trade credit insurance, having a prudent overview of it to make sure you're properly covered and you're properly insured for your trade receivables. This leads us on to the benefits of trade credit insurance. A bit like why trade credit insure, we have 7. I've picked out 7 key benefits here. Again, each individual business, there's certain aspects will strike with them more than others. At the moment, the key one for me would be the increased market intelligence. This is going to be a key factor moving forward for all businesses to know exactly how your customers and how your prospect customers is performing in the trade credit sphere in terms of is underwriters writing cover or they're not writing cover. This is valuable information for you as a business to be able to plan and support positive growth, to be able to target new quality customers. All this market intelligence will play into that, and it's all part of the trade credit insurance offering. Other benefits within trade credit insurance, you have greater access to finance facilities. If you've invoice discounting facilities or needing sort of lending facilities from banks and whatnot, trade credit insurance gives you that safety net and gives lenders that guarantee to offer better competitive rates. You have the fast replacement of working capital. In terms of a claim scenario within trade credit insurance, normally within 14 to 30 days, you would have an insolvency claim paid out with all information being passed across to to the insurers to review. So it is a very fast replacement on the working capital side. It keeps the cash flow ticking over, and it means there's no gaps there in terms of cash flow. Finally, it enhances your credit management procedures. So trade credit insurance, in my view, it completes the circle. So it gives an extra string to the bow for your credit management procedure team. It gives an extra layer for the business. A lot of the insurers do have integrated debt collection services, and a lot of clients will avail of that. Whenever debt gets to a certain stage, you can pass that across to the insurer. They will chase the debt on your behalf. Again, that frees up time then from your staff's time to be able to then concentrate in other areas, etc. And finally, then it greatly reduces the need for a bad debt reserve requirement. And on the benefits within trade credit insurance, the majority of my clients, whenever I chat to them, the one key thing they'll constantly say to me is peace of mind. It's peace of mind knowing that your spread of debtors, your spread of risk is fully covered. It's peace of mind knowing that should something happen untoward, that you have the insurance protection there. And it greatly allows them businesses to concentrate on growth and concentrate in key areas. Finally, then on the fact-filing mission on trade credit insurance, obtaining a quote. There's a bit of a myth that it's a very long, tedious process to obtain a trade credit quote. You need pages on pages of documents to supply to the underwriters to get quotes, etc. That's certainly not true. It's as simple as illustrated in this slide, a 10-minute chat to discuss through the key information over the likes of a cup of coffee, etc. is all that's needed to really flex out these three key areas. And in terms of insurable turnover, which is your insurable turnover excluding public sector bodies, excluding cash, etc. Your key customers and prospects, normally we'll have a portfolio of 10 or so, and then we would go through those 10 customers and we would see what your highest exposure would be over the course of the year. That's where we would pitch the credit limit at. That's where we would set the credit limits at. The insurers then would come back and see if they can write the cover. Point of note on credit limits. Credit limits are they're flexible. They'll adjust during the policy period. So they will increase if need be. If you're bringing on new contracts, you can increase your credit limit, or you can reduce your credit limit as well if contracts are falling off or coming to near completion and exposures reducing. So it's very much a work in progress. You can add on new customers as and when required. It's not set in stone that when a policy is taken in place, you have set credit limits and that's it. It's a continual moving feast on that regard. Finally, then the third area that trade credit options and quotes is required on is the recent bad debt history. So again, it's a quick synopsis of the last 3 years of the bad debt history of the company. A quick chat on any concerns in the overdue accounts. As soon as that information then is passed on to myself in terms of a 10-15 minute chat, I can package that up. My team at ABL Trade Credit Division can package that up as well and send that across to the market. We have access to the entire trade credit insurance market. We can get the terms that's needed, etc., for your business moving forward. We have all channels open to ourselves, and it's as straightforward as that to be able to get a quote. It can take 3 to 4 days for the market to work through the variables. Within that time period, then we'll be able to present an option to you in terms of A, how much does trade credit insurance cost, and B, how much coverage is there for your debtors and your spread of debtors. Obviously, very important topic at the moment, and I'm sure some of the guys on the call have maybe experienced this. It's improving your credit rating. Going forward, it's going to be crucial that all businesses are as open and transparent with underwriters as possible and provide as much information as possible that they have and as much up-to-date information. The reason behind this is it keeps your credit limits opened. It allows the underwriters to continue writing credit on your business. for your suppliers. It gives them the confidence and the most up-to-date information to expand on capacity on your business. And certainly what I'm seeing at the moment, it's happening very much in the marketplace, is that underwriters are reaching out to businesses and highlighting that they require up-to-date information. There's 10 or 12 underwriters that write cover within Northern Ireland here. So you can imagine if that's over a 6 to 7 month period of 12 underwriters writing to you, asking for X, Y, and Z, it can become quite tedious, time consuming, and a lot of work involved. We at ABL Group, we can assist on that. What we can do is we can establish, first of all, what cause cover to be restricted if that's the case, and advise them what information is required to the underwriters, and liaise in that regard to make sure that you're speaking to the key underwriter, the key decision, at a speedy time. That means there's no time lost. We can arrange then non-disclosure agreements within the insurance market and arrange meetings with relevant underwriters. We can also provide guidance then on the capacity that the insurance market has on your business. Again, this is key for you and your suppliers to keep the credit chains open. Insurers may be at capacity, and again, it's just a simple phone call may suffice to supply a bit of information that the insurance market then can increase your credit rating. And again, this is something we can assist with. We can package this up. We can send this across out to all insurers to make sure there's capacity for your business with each of the insurers in the market, and there's no problems with any headroom in that regard. Finally, then I just want to take a quick sort of run through some of the recent construction insolvencies. It is very real at the moment. Insolvencies are happening across all sectors, particularly in the construction sector. It's always a sector that finds it very hard and is hit very hard. I'm sure everybody's familiar with these 7 companies, or most of these 7 companies anyway, on the screen. The likes of Midas Construction there recently went into insolvency with 60 million of debt. The likes of McFS had 11.1 million of debt owed. The likes of Caledonian Modular, there's 11.2 debt owed in that aspect to unsecured creditors, and the word is that there'll be no money back on that. That will all be basically lost invoices. In terms of Road Bridge, I know Terry's gonna touch on Road Bridge. Again, there's 60 million debts there, with 22.5 of those belonging to subcontractors. So we can see in a range of construction firms over the past number of months struggling, and with cash flow being a key area, and obviously insolvency then is creeping in. Since the start of the year, so from sort of January, there has been just over 100 insolvencies across the UK construction sector, with the highest peak being in February. There was 31 construction insolvencies recorded in February. The forecast for the next 6 months is that there's going to be a larger volume, and certainly that 31 forecast is projected that will surpass that in one given month. So there's a lot of uncertainty out there. Insolvency is very real. It is happening, and it's something, certainly it's a very opportune moment to have a review of your internal requirements for trade credit insurance. And certainly myself and my colleagues at ABL would be delighted to chat you through the options, to provide the options to you, and to give you that safety net and security that a trade credit insurance policy brings. And with that, I would like to hand over to Terry McCauley from Tokyo Marine HCC. It's great to have Terry with us today, so I'll pass across.
Hi, thank you, Mark. Good morning, everyone. I just wanted to quickly talk through the construction sector from our perspective and what we've seen in our conversations with some of our policyholders and buyers that we have dialogue with. And looking at the industry as a whole, you can see that the monthly index shows the level of construction output grew to an all-time high in March 2022. and that was after its 5th consecutive monthly increase. Q1 also represented the first time the construction sector had achieved volumes above that of pre-COVID. When you look at the NISRA stats for Northern Ireland to the end of Q4, it paints a broadly similar picture to the rest of the UK. Of all the construction contractors that we're speaking to across the UK, order book size is not really being cited as a major issue for them in terms of any of the current difficulties that they're facing. Just looking at the specific areas which are contributing to the growth, you can see that 2 of the leaders here are infrastructure and private new housing. The current government has been really clear in terms of their commitment to infrastructure spend. And they recently set out a plan to spend 650 billion over the next decade. So provided the Tories are re-elected again in 2 years and that plan comes into effect, it doesn't seem that infrastructure spend will be slowing down anytime soon. Without wishing to dwell too much on politics, and I know that Mark touched on it as well, clearly for Northern Ireland, it's a little bit more difficult without a functioning executive. The decisions on public sector procurement are either really slow or absent entirely. In terms of private house building, over the last few months, it's been, well, over the last 12 months, it's been fantastic. It's really been a big boost to the construction sector, and no huge surprise in that, you know, in all parts of the UK, we breed quicker than we build. So there is always a requirement for more houses. It is, if you can just read out or make out the light blue line at the top there, you'll see that it is losing momentum, and I expect that to happen more and more. I think Mark also touched on the considerable inflationary pressures, the effect that has on people's discretionary spending. If you combine that with the fact that it's likely that we will see some further interest rate rises, I expect both house building in terms of volumes and also house prices to start to drop over the second half of the year. But if order books and demand levels generally aren't the main issue for the construction companies out there, what exactly are the issues? Something that nobody will have been able to ignore, the material price increases. So you can see that materials prices have risen each consecutive month for the last 19 months. Looking at structural steel, 46% jump year on year and continuing to rise this year. The war in Ukraine continues to have a huge impact on steel prices. That has really driven up the cost of energy across the EU. Most of the EU member states are continuing to try and reduce their reliance on Russian oil and gas. And the manufacture of steel is a very energy intensive process. So much so that some of the UK steel manufacturers that we've been speaking to have actually had to reduce their output because it is simply too expensive to consume the energy at peak times of the day. If you couple that with the fact that we have placed sanctions on Russian steel, it's pretty clear that, you know, across Europe, availability is reduced and demand is actually quite high coming out of COVID, and that imbalance will likely keep prices high. Brick prices, admittedly just from one manufacturer here, but a fairly substantial one in Forterra, they lifted brick prices by 16.5% at the end of last year and by a further 12% in April this year. Cement and concrete products up 27% year on year. Timber prices, insulating materials, it really is across the board. And when you add everything together, year-on-year prices for all building work rose by 25% between April 21 and April 22. One of the other issues that some contractors are dealing with is red diesel. So as we know, as of the 1st of April, the conversion to white diesel was made compulsory. Based on the current prices, white diesel is 68% more expensive. So if you look at who that affects the most, typically we use the example of ground workers already operating on relatively slim margins, and they get a really disproportionately high hit on costs and therefore a reduction in their profitability. For me, it felt like this was a a slightly premature move by the government. We all understand the sentiment of net zero and carbon reduction, but the alternatives, in terms of electric technology, that's really still in its infancy, and there's a lot of issues around charging practicality on site. And with regards to the HVO, mainly alternatives, we've heard repeatedly that there are significant supply issues and that people are finding it difficult to change en masse from diesel to HVO because they simply can't get their hands on enough of it. And the government promised 40 million of funding to assist with the transition period. And that really just feels like a bit of a drop in the ocean. And just wanted to touch on construction funding and debt. So with increased activity levels, businesses will also start to see any COVID loans that they've taken or other emergency financing during COVID. The repayments for that will have to commence reasonably soon. We've been living with the reverse VAT for some time, and now the increases in material costs, which don't seem to be slowing down massively. All of those things combined have a real significant impact on working capital. So that's something that every business which is suffering from this will need to address. Fixed price contracts, that's probably the most common conversation we're having with contractors, whether it is true fixed price or cost plus. The plus element doesn't seem to be enough to cover the actual rise in prices. A lot of contractors have been working through historical fixed price contracts, often at a loss. And when you combine that with the rising materials cost, increased activity, and the fact that what you're doing right now is actually producing a loss, the ability to secure suitable liquidity to make sure your business survives, to be able to fulfill the order book that you're creating today on better costs is really critical. In terms of the lenders, there is more and more noise from some of the mainstream banks about their own ESG credentials and their ambition to transition towards net zero investments. And if you think typically of a construction company, that's not necessarily a prime target for net zero. So it's going to be, over the medium term, something that every construction company that relies on debt needs to be aware of, and the banks will probably increasingly put an onus on the construction company to demonstrate that they are reducing their own carbon footprint to be able to be suitable as someone to lend money to. The good news is that the amount of private equity activity within the sector has increased. We've seen some very big acquisitions in the last sort of 12 months. And in terms of private equity, that capital comes with many strings attached. But on balance, if it is a new source of capital for the sector, it will be very much worthwhile, and it will outweigh the drawbacks of how that financing is derived. So what solutions are available? This is really just some of the conversations we've been having with companies that are already distressed. So we've spoken to a number of buyers which were showing signs of distress, and these are the answers that we've been given in terms of this is what we're planning to do. First and foremost, explore your refinancing options. So for those companies that either have a very sound plan, which will forecast good results in future, or those companies which are experiencing short-term difficulties caused by factors outside of their control, but can demonstrate previous good performance. The mainstream banks in the UK have been extremely supportive over the last 2 years in terms of debt restructurings and covenant waivers. So the first port of call should always be with, how can I arrange my liquidity in such a way that will ensure that I have at least 12 months forward to try and trade out of any issues I'm having. If things are a little bit worse than that, or the bank aren't compliant, find a buyer. So companies with future growth potential or very repeatable cash flows are incredibly attractive to buyers, and especially in the private equity market, they often try and exploit potential future growth. So they will look at potential and give more weight to that over and above the current reality of the performance of the business. And lastly, innovate the company's contracts. So across the sector, with some very large main contractors, we've seen over the last 18 months people evaluating their business throughout the COVID period. And the result of that in a lot of instances was that some of the big players had decided to trim down in terms of refocusing on their core business and trying to sell subsidiaries that were involved in other things that weren't considered core, that had maybe been acquired when they were trying desperately to grow to appease shareholders at a certain point in time. If you don't want to sell the entire business, but there are particular contracts which aren't specialist to you and you don't feel like you can make them work, it may be possible to transfer some of those contracts, including both their obligations and rewards, to another firm, leaving the business slimmed down and with more of a focus on exactly what they're good at. Just in terms of where we see the market going for the rest of this year and next year, again, can't emphasize enough the ability to price work correctly for the materials environment that we're in is absolutely critical, and equally the ability to work through anything that you have priced at a rate which no longer makes sense in today's price environment. The ability to get through that is also entirely critical. Coming out of COVID, obviously we've seen the bigger volumes of work. Every time we come out of a recession and we race towards growth, we as insurance companies see more claims. That's just the way it happens. The working capital demands, funding demands, as soon as a business tries to overstretch itself and take on too many orders that it can't finance, it starts to run into trouble. The lack of skilled labor, I mean, we probably see that as more of a problem over the medium to long term, but clearly it still is there lagging in the background. It's something which everyone will have to consider and address. And the concerns around the materials price increases, it doesn't really feel like there's a huge amount of macroeconomic indication that is going to ease in the short term. And some of the recent insolvencies that we've seen, the directors have been citing that either the lack of or the cost of materials as the major contributing factor to their demise. And just wanted to finish on our business, and just to give you a little bit of an insight into the mind of an insurance underwriter in terms of how we approach the analysis of a construction company. So you can see the 6 bullet points around the central analysis theme. There's one I've foolishly omitted, which I'll touch on in the end, but starting with profitability, that's fairly straightforward. We want to ensure that businesses can be run in such a way that produces a positive return for the shareholders. Trends, so turnover and profit in isolation in one single year of account is a very useful piece of information, but it's much more insightful when you view it in conjunction with historic results. So we tend to review the results over the last sort of 3 to 5 year period. We also often compare the results of any given construction company against that of their peer group. Balance sheet size, so in every sector, that's often the barometer of the business's ability to withstand a period of poor trading or loss-making trading. In relation to contractors, we also place a lot of emphasis on the size of the balance sheet relative to the turnover of the business and their average contract size. So a contractor taking on individual contracts well in excess of their net assets can only be one problem contract away from failure. work in progress. So something we've seen in a number of recent failures, and Mark flashed it up on screen. Midas, that was a good example of huge work in progress balances increasing year on year on year, a lot of which related to uncertified adds to value. It just consumes cash, inflates the balance sheet, and can often be subject to really lengthy adjudication processes. So it's classed as a current asset when, in some cases, if depending on the accounting approach that a company is taking, in some cases it's far from current. And as part of our role, we actively speak to buyers. We arrange meetings with buyers that we're exposed to, and we will ask those questions. Debt and funding, as I already touched on, as an underwriter, you're essentially trying to write 12 months into the future. So we try and underwrite in such a way that we're not giving you a limit today to take it away next week. We're hopefully writing a limit that will be good for a 12-month period. So it's always important for us to be able to demonstrate and satisfy ourselves that the business has adequate liquidity based on their current trading trends to be able to survive for the next 12 months. And cash conversion. So Carillion's probably the best sort of recent large example here. A company's ability to convert profit into cash is absolutely critical and something that we pay close attention to. And if I had a choice of, you can either analyze the P&L or the cash flow statement, it would be the cash flow statement every time to get as a barometer of how good the company is and how creditworthy they are. And the thing that I neglected to put on the slide, but is also massively important, and I think, again, Mark touched on it, as he mentioned, the service that ABL provide in terms of liaising with the underwriting market on your behalf. We proactively get management information from hundreds, possibly thousands of businesses across the UK as a matter of routine. We also have a UK market-leading surety business, which we have the benefit of sharing information with. So between us, we are very well resourced in terms of the construction market in particular, in terms of the amount of proprietary information that we capture. And I just wanted to touch on Roadbridge. So I've just included a couple of highlights, financial highlights from the last 2 years worth of accounts here. And you can see that in terms of top line, turnovers held up fairly well considering the pandemic impact. The only couple of things that jump out, operating margins are relatively slim at 1.1%, but with a pre-tax profit of 1.8 million, it's a perfectly credible performance. The business had a net worth of 79 million euros and cash of 13.5. Gearing was sub 60%, which we don't consider to be especially high at all. The only other point of note was the work in progress there at 88 million, which equates to 33% of the turnover. And we would normally expect to see this by analysing every construction company that we have in our records, of which there will be upwards of 30,000. We would expect to see that at sub 20%. And by their own admission in the notes to the accounts, some of that was tied up in a slower than expected adjudication process. The actual reasons for the failure cannot be seen here, and I'm sure a lot of people on the call probably know what actually happened, which I can't comment on, but it just goes to illustrate the importance of credit insurance, because if you had any grading report, Dun & Bradstreet report on that set of financials, it would speak for a pretty high credit limit. And those companies which still present fairly credible results can still be vulnerable, as these guys have proven. We did pay claims on Roadbridge to several policyholders. So whilst they lose a customer, they certainly didn't have a bad debt. And as Mark alluded to, we pay claims pretty quickly, and those were all settled within 14 days of the administrator being appointed. And that really just demonstrates the the value of credit insurance. It's for those ones that they're so unexpected. And just to finish, just a little bit about our business. So just wanted to throw up the percentages you can see in the circle on the left-hand side are our limit satisfaction ratios. So simply, if you apply for 100K and I provide you a limit of 85K, my satisfaction ratio is 85%. This is across our entire portfolio of buyers. And you can see in February 20, pre-COVID, it was 82%, and December 20, it was still 82%. So we didn't bow to the temptation of making wholesale cuts of cover just because of the pandemic. We tried to understand what the government measures were going to be, how that was going to impact insolvencies. We were probably the only credit insurer in the market that I'm aware of that didn't join the UK government reinsurance scheme because we were confident in what we were doing. And that, looking back, that proved to be a good decision. And the point here was that we try our best to be a consistent underwriter, which is what I mean in terms of we write a limit thinking that it will stay in place for 12 months. That may not always be the case, but that is certainly our aim when underwriting the limits. Our exposure as at today is the highest it's ever been in the company's history. And just to give you some context, we make over 3,000 limit decisions every month. And the same in terms of monitoring actions. So every one of our customers, we complete monitoring on. So we're looking at every time they file a new set of accounts, every time there's a CCJ registered, anytime they're overdue in filing their accounts, anytime the directors change, anytime the ownership structure of a buyer changes, we are manually monitoring all of those changes, and that equates to more than 3,000 every single month. We're currently writing about 100 million of additional cover each and every month. Looking forward for us, again, Mark touched on it, the insolvency stats for April 22 for the UK. Total company insolvencies were more than double that of April 21, which is a bit of a headline grabber, but in context, April 21 was really benign. But the meaningful comparison is with April 2019, and it was 39% higher than that. So in Northern Ireland, the curve of insolvencies has been a little bit slower to bounce back up. So it's considerably above, but it is still considerably above where it was last year. As you would expect, a big uptick in companies going bust means an uptick for us in claims, and that's certainly what we've seen so far this year. For us, construction has notably led the way so far this year. We think the rest of 2022 will continue to be challenging for insolvencies, and I expect certainly 2022 to finish the year above the volume of insolvencies that we saw in the UK in 2019, pre-COVID. But we will continue to support our customers as best we can, and you can see from the most recent limit stats I have included there to March 2022, our appetite and our satisfaction ratios are still holding. Thank you for your time. That concludes my presentation.
Terry, that's great. Thank you very much. And I think you and Mark are going to be good enough to maybe take a few questions and comments. Now, I'll let you get your breath, Terry, because you've been speaking most recently. Just a couple of observations, maybe for Mark. Just talking about the rates being lower in this post-COVID period. And I suppose that sounded counterintuitive until you explained it, but you know that's a positive, obviously, for the market at the moment. Do you see that remaining at that level, or do you see the rates going up again?
They certainly will increase again, Mark. You know, in terms of, as Terry has highlighted, with the insolvencies projected to rise and the claims obviously coming in rising as well, that has a knock-on effect on the premium rates. Yes, we certainly are very low. Aspect at the moment, as Terry has highlighted, during 2020 and 2021, claims were relatively low. Therefore, insolvencies were low as well. Premium rates then dropped. Obviously, as the claims increase, the insolvencies increase, the premium rates will will follow suit in that regard. So certainly they will increase over the coming months as the expected claims and insolvencies do happen within the sector.
Okay, just from my own curiosity, I suppose a couple of years ago, before price rises and so on, commercial contracts might have been perceived as slightly more risky than public sector contracts. I think we always regarded the public sector as blue chip. It might be tight margins, but they're a safe client. You always get paid eventually. Unfortunately, they tie us into fixed price contracts. So from your perception now, are public sector contracts maybe perceived as higher risk than they were? And are they now perceived as higher risk than commercial contracts, possibly?
Obviously, there's a clear execution risk for the contractor that's engaging with the public sector, for sure. I mean, our policies don't tend to cover public sector contracts, because when you're dealing with the government, we assume there is no insolvency risk. However, the risk of execution is absolutely there. I totally appreciate that, and would totally agree with you, Mark.
Yeah, no, difficult times. There was a detailed question, and I know you guys will be very happy to go back to the questioner on it, but I think that the general point that was being raised was a lot of the times the data on which you're assessing can be slightly out of date, and that's because you're relying on published financial data and so on, and particularly with COVID, we were allowed extensions to accounting periods, which I know a lot of contractors availed of. So how do you add to that data to make it more real time, I suppose, is the general question. How can we be on the best possible information at a point in time?
So yeah, as I touched on, we actively pursue companies to obtain information from them, management information from them. So we, particularly in the construction sector, we're quite fortunate in that we're our sister business is a leading surety business, and as you know, with surety, the balance of power is slightly different. So we tend to go with cap in hand, asking nicely for information. And it's a little bit different for a surety business. They insist on information as part of the bond requirement. So there's a really good flow of information on that side of the business, which we have total visibility of. And over and above that, we do our own things to ensure that we have enough information on all of the non-surety businesses that we need it on. And we work on the basis that it will generally be for when we have exposure above X level. That's what there is an internal criteria that we use in terms of how to deploy resource. We would love to say that we are engaged with every single UK company that operates in construction, but that's not really practical for us. So, but I think in terms of us against our competitors, I think in the construction space we're very well matched in terms of exactly how much proprietary information we do collect.
No, thanks for that. What came across very clearly is the detailed knowledge you obviously have on construction, and I think allied with ABL's local knowledge in NI, I think that's critical. And Mark, back to that point, I suppose you very kindly offered you can maybe assist on occasions your clients with their credit ratings if they're having particular issues.
Yes. Yep, that's exactly right. That's a service we can provide, Mark. In terms of, as Terry has highlighted, it's very important going forward that underwriters have the most up-to-date information at hand to be able to keep the credit lines open, to be able to increase capacity, etc. So it's vital then that's facilitated, and that's something we can do with our reach with the trade credit insurance market, being able to reach the correct underwriters. It's looking at the portfolio, getting the information in a timely manner, which doesn't delay any knock-on effects then for any member of CEF that's experiencing difficulty with getting credit cover, etc. So that's certainly something we can help assist with and collate all that together and send that information around the entire market. So it's not it saves going to each individual underwriter. There's 10 or 12 or so that might fit Northern Ireland there. We can send that out all to the relevant parties, collate all that, and just streamline that process then for your members.
And from our side,
very valuable.
Just from our side, Mark, in terms of reviewing cases and getting new information, we're always incredibly receptive. It's really valuable to us. So we welcome any new information we can get our hands on.
Yeah, no, I think that's incredibly helpful, because it is a frustration, isn't it, sometimes in the market, that people are hamstrung by the last set of accounts when actually there's a lot better information available to them. There are no other questions unless somebody wants to type one in very, very quickly. But if we're not seeing that, I just want to thank you both. That was an incredibly detailed, very comprehensive overview of your services there. We'll have recorded this. It'll be on our YouTube channel, available for people who were scribbling notes like I was and maybe want to go over the detail again, and your contact details will be there. But I want to thank you both for taking the time out to do that today. It was incredibly helpful. Mark would like to thank ABL, as always, for being our patrons. And I know in the background you take queries day and daily from members, and that's much appreciated as well. But Terry, appreciate the input today for Tokyo Marine HCC. Very much appreciated your detailed knowledge. Very impressive there. And you guys obviously make a good partnership. So we're delighted to have had you host the webinar today. And thank you very much. And everybody who logged in,
my pleasure.
useful. Thank you. All the best. Bye-bye.
Cheers.
Thank you. Bye-bye.